Recently, there's been a lot of videos about how our net worth explodes after we save our first $100,000. Videos like this one, and this one, and many, many more. But there's a part 2 to those videos, and I want to make sure that we focus on that today, because as we're building our net worth in order to prepare to retire, I think it's important we know what the challenges are and we know what the road ahead looks like. So let's jump in, and first let me share with you the quote by a very smart investor that sparked all of these videos. It's by Charlie Munger, who says, "The first $100,000 is a beep, but you gotta do it. I don't care what you do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit." I completely agree with Charlie's quote. In fact, I made my own video about this topic right here. And in it, I talk about this, but I didn't stress it enough, so I want to share with it. Okay, first off, Charlie's quote was at a talk that he gave to the business school at USC in 1994. So as I record this, that was 31 years ago. That was a long time ago. And the value of $100,000 today is much greater if you looked at it just on an inflation basis. Let's call it $250,000. And that's a critical number. We're going to come back to it. But first off, how long does it take you to save $100,000? Turns out it takes a long time, particularly if we're starting with zero. As you can see in this chart here, if you saved $10,000 a year and you got a 7% rate of return on that, you're not going to get that in a bank account. That's an invested account. Probably something like 70-30, 70% in the stock market, 30% in high quality, short duration bonds. It takes almost 8 years to save that first $100,000. And you can see that almost 80% of the money that first $100,000 represents, 80% of that was money we put in. You can see that in the blue down below. And the returns by the magenta color here was 22%. But look at what happens after we save that first 100,000. The next 100,000 just takes us a little over 5 years, and it's about half and half. Half of it is money that we put in, and the other half is growth. And let's look at 400 to 500,000. Here, it took just 2.5 years to gain that $100,000. And it was only 30% of that $100,000 was money we put in, and 70% was growth. And for the last one I'll share here, between $900,000 and $1 million, it takes less than 1.5 years to get that gain at a 7% gain. And here it's less than 15% of that $100,000, less than $15,000 we put in, and the rest was the growth of the account. But there's a couple important caveats here, right? How long does it take us to get to $1 million? This Excel spreadsheet shows us that if we start with zero, we save $10,000 a year, 7%. You can see that same 7 to 8 years to get to the first $100,000. By the end of the next 10 years, after 20 years, we have a little over $400,000. And finally, after 31 years, we have $1 million. But there's a couple important caveats. One, that's a heck of a long time. And after 31 years, that $1 million is not going to feel anything like $1 million. We're going to come back to that. And the third one that's super important is, boy, wouldn't it be nice if a 70-30 portfolio just every year went, from lower left to upper right in the returns? But unfortunately, that's not how the market works, right? We see big years, like as I record this over the last 2 years, the stock market's up over 50%. That's a huge, huge number. But you know what? There could be some surprises in the next couple of years. It could be down as well. And unfortunately, the stock market takes the escalator up. It takes time to get those returns, but it tends to take the elevator down. We saw that in COVID. We saw that in the great financial crisis. In COVID's case, The market dropped 30% in just 4 weeks. Imagine that. Imagine if you had $500,000 and it was all in the stock market and it dropped 30% in just 4 weeks. In less than a month, in 20 trading days, people with $500,000, if they lost their, that's $150,000. They went from $500,000 to $350,000. So those are the 3 caveats. The other one is, even if we save more money, it takes a long, long time to save $1 million. Let's say instead of saving $10,000 a year and getting that 7%, remember that took about 31 years. If we save $20,000 instead of $10,000 a year, well, then it would take us about 15 years, right? That's how we think, but unfortunately, that's not the case. If we double how much we save, we need to go back and look at what point were we at $500,000, and then we double that to get to $1 million. So unfortunately, it takes about 23 years, 22, 23 years. If we double that savings, and $20,000 is a lot of money for most of us to save. So here is when our net worth begins to explode. And unfortunately, in today's world, it's not at $100,000, right? It's $1994 when Charlie Munger made that quote. That $100,000 is like $250,000. So let's see what would happen if we started with $250,000 and we were able to save 20% a year. Even in that case, it still, unfortunately, takes over 10 years. It takes us somewhere between 12 and 13 years to get to that $1 million mark. So it takes a long time. Now, importantly, what does this $1 million feel like when we finally save it? So in the last example, I said we get there in about 13 years. What does $1 million look like? What does it feel like? Even if the stock market returns were steady, and it's not. The stock market returns are very lumpy. Even if it was steady, even if we had that steady ride, after 13 years at just 3% inflation, that $1 million feels like, in purchasing power, little less than $700,000, $681,000. Now, in the second example where we had $100,000 and instead of adding $10,000 a year, we added $20,000, which again is hard for people to do. After 22 years, it feels like a little more than $500,000, $520,000. And unfortunately, in the example where it took us 31 years, really, to get to $1 million, that's going to feel like just $400,000. So what do? What we do is we save as much as we can. We spend our money on the things that truly give us joy, as opposed to just buying stuff that maybe doesn't give us joy. I shouldn't say this is what we should do. This isn't financial advice. These are just things I have learned as a financial advisor, as an individual. We do the best that we can, and unfortunately, saving 10%, which is how many of our parents, in our parents' generation, they could save 10% and probably be okay in retirement because they didn't have to worry about Social Security going away. They saved some money, that 10% on their own, but importantly, a lot of people had pensions back then. For most of us, the pensions are gone now, so that's what we have to do. The importance of saving is super important, never more important than now. And alongside with that, we also have to balance our health and wanting to be able to enjoy our retirement, which is why I made this video here, which is kind of part 2 to this video. It's actually up here. It's why waiting to 65 to retire might be a big mistake. Thanks for watching this video. I'll see you in that one. Bye-bye.